Welcome back to Chapter 8 in your Cornerstones textbook. We're moving on in thinking about current liabilities, and now we'll talk about sales tax. Very common way to accrue a liability at the end of a quarter or a year. Now, sales tax comes in several different forms. Sometimes it's actually called sales tax, other times usage or excise taxes, but in any case, they are taxes that are levied on businesses who sell goods. They're not part of revenue, though they are technically collected at the time of sale. So you don't want to include the amount of sales tax in the total revenue, but you will actually collect it at the cash register or while collecting a bill. They're not remitted every day. There is currently no state that requires sales taxes to be passed on to the state every single day. They're usually remitted every quarter, though for some businesses every week or every month. And what happens is a business would build up an accrued balance during the quarter or the month until they actually have a chance to pay the sales tax. So let's look at Cornerstone 8.2 to see how this works. We have McLean County Tire. They're in the state of Illinois. And during the first quarter of 2012, they sold 3,000 truck tires at $75 each. There is an Illinois state sales tax of 7% and the city of Bloomington tax of 1%. The taxes are paid to each appropriate taxing authority once per quarter. So first, let's just deal with the first quarter sales. The end of the first quarter would be March 31st. And we would want to say that since these were all sold on credit, all the tires were sold on credit, the company would have accrued an accounts receivable balance of 3,000 truck tires times $75 a tire, $225,000. Now that's the sales revenue piece. However, accounts receivable has got to include the 7% sales tax for the state of Illinois and the 1% city of Bloomington sales tax. So it would actually be easier for us to first figure out the rest of the credit entries and then make sure they add up to the proper accounts receivable amount. Sales revenue, $225,000, which is 3,000 tires times $75 per tire. Now the sales tax payable to the state of Illinois is going to be 7% times $225, which comes out to $15,750. And then there is sales tax payable to the city of Bloomington, and that's going to be 1% of $2,225, which is $2,250. If I add the $2,250 plus the $15,750 and the $225,000 all together, that would be an accounts receivable balance of $243,000, which would be our debit entry. Let's look at it all nice, neat, and clean here. Again, this is how we accounted for sales revenue. This is how we figured out the Illinois state tax, and this is how we figured out the city of Bloomington tax, and altogether they equaled the accounts receivable. Now let's prepare the journal entry to record the payment of those taxes. Well, let's say that the payment's going to occur on April 10th. It's very common for the payment of sales tax to occur a few days after the end of a calendar quarter. So the calendar quarter ended on March 31st. About 10 days later, sometimes 15 days later, the company actually pays those taxes. Now remember, they had sales tax payable to Illinois and sales tax payable to the city of Bloomington. It was $15,750 they owed Illinois and $2,250 that they owed to Bloomington. Remember, we are clearing two payable accounts, which means we are going to debit them, and then we would have a credit to cash for the full amount of those two sales taxes, which is $18,000. Another common form of a current liability is something you've seen before, and that's unearned revenues. Remember, an unearned revenue is a liability that gets created because customers pay in advance for their goods or their services. The amount of that prepayment is a liability. Now, one very specific unearned revenue that we haven't dealt with yet are gift cards or gift certificates. And I'm sure you're quite familiar with those if you've had a recent birthday, or if you remember Christmas or a wedding, you know that these are very popular. And businesses have to be careful on how they deal with this unearned revenue. It's recorded as a debit to cash because someone purchased the gift card from the business. That's the prepayment amount. And then there's a credit to unearned sales revenue. Let's look at Jim's Steakhouse. Cornerstone 8.4 in your book deals with Jim's Steakhouse. They sell $100,000 of gift cards during the month of December in 2011. These gift cards may be redeemed at any time, but they expire exactly a year later on December 31st, 2012. During the calendar year 2012, $98,875 of gift cards were redeemed. So first, let's prepare the journal entry related to the sale of the gift cards. Well, they sold $100,000 of gift cards, and they did that during the month of December. So I'm going to say December 2011. I'm going to make a journal entry where they received cash of $100,000. So that's a debit to cash, because that's how much individuals gave them for the gift cards during that month. And then I'm going to record a liability in the unearned revenue account for the exact amount of the sales. Now let's prepare the journal entry related to the redemption of the gift cards. This is how much, in terms of dollars, that the gift cards were redeemed. So on December 31st, 2012, I can say that I can clear, in the unearned revenue account, I can clear $98,875. And that means I can now finally record the sales revenue. Remember, we can't record a sales revenue until the service or the good has actually been delivered or completed. And so finally the good has been delivered. People got their steak at Jim's Steakhouse. So I can record the sales revenue during the year 2012 to the tune of $98,875. There we go. There it is. But you might be asking yourself, what about the additional $1,125 of gift cards that now expired? They weren't redeemed during the year 2012, and they expired on December 31st, 2012. What do we do with those? Well, it turns out we still have to clear that unearned sales revenue. So we know that on December 31st, 2012, we also need to deal with that $1,125 of gift cards that were expired. Still going to clear unearned sales revenue for that amount. But what do I do with the credit entry? Well, it turns out the business can also record the unused gift cards, the expired gift cards, as sales revenue for that period. Because after all, they'd received the $100,000 in full a year before. Just because a few customers did not redeem all of their gift cards, it turns out Jim's Steakhouse is able to recognize all $100,000 of it between the $98,875 of redeemed gift cards and the $1,125 of expired gift cards. All of them can be counted as sales revenue. Last but not least, your chapter deals with things called contingent liabilities. These are liabilities where it's not clear that there is a definite obligation for the company, but there is a probable future obligation. And it's possible to reasonably estimate the amount of liability. So the best examples are warranties on products, pensions that might be owed to retirees, although you have to estimate how long you will be paying retirees since it all depends on a person's lifespan, as well as lawsuit settlements. Now again, something like pensions and lawsuit settlements, you have to make some good guesses as to how long a retiree might live or how long their spouse might live. Or for a lawsuit settlement, how likely is it that a company might have a finding against it, and how much might that penalty or that settlement be? In the case of warranties, we have a little bit of information in your book, and it tells you what to do if a reasonable estimate can be made and if the warranty is probably going to be used versus if the warranty has a very remote chance of being used, or if there is not a reasonable estimate to be made. And you can find this chart on page 398 in your textbook. For warranties, remember those are guarantees of repair or replacement on any sort of product, and it is a sales-related cost. It's completely related to the sale of a good, which means it's got to be matched to the period of the sale. Because defective products rarely pop up exactly in the period of sale, they often need to be estimated. Actual warranty repairs will rarely equal the estimates of the warranties because that would be pretty hard to do. However, large over or under estimates must be reported on the income statement as soon as a company recognizes that they have either over-reported their warranty estimates or under-reported them, and that would be recorded either as other income or other expenses on the income statement. Let's look at an example in Cornerstone 8.5 in your textbook. We've got Nolan Electronics Company, and they offer a 12-month warranty on all computers. They estimate that one computer of every 2,000 sold will require warranty service, and that average warranty claim will cost Nolan $155 per claim. Now you'll notice there's a 12-month limit on this warranty. That's not uncommon when we deal with warranties, and that's so that a company can limit how long it might actually need to pay out. So first, let's prepare the journal entry to recognize the warranty expense and the associated liability, assuming that Nolan sold 3 million computers during 2011. Now, first we have to figure out that expense. We know that we're saying that the company sold 3 million computers. We believed that one computer for every 2,000 sold would actually require a warranty repair, and we think that the estimated warranty repair is $155. So $155 times 3 million computers times 1 for every 2,000, we come up with an estimated warranty liability of $232,500. And this is as of the end of the year. So we know that the warranty liability is going to be the credit entry. And we know that this is one of those accrued liabilities, which means we are going to have to debit some sort of expense account, which will be, believe it or not, the warranty expense account. So warranty expense gets a debit for the total $232,500, which we got in this formula down here, and then there is a credit to warranty liability. Now let's say that in the month of January 2012, there were so many warranty repairs and in order to complete them, Nolan sent $10,400 in cash as well as $8,300 in parts to its dealers for the warranty repairs. So in the month of January 2012, we would want to reduce the warranty liability by the total amount that had actually been spent, so the $10,400 plus $8,300. So warranty liability is being reduced, and the way to reduce a liability as a debit entry is being reduced by the total spent of $18,700. Now cash is going to be credited for the $10,400 in cash, and the inventory, which is Nolan's parts inventory, is going to have to also be reduced. That's an asset account. So that's going to have to be reduced with a credit entry of $8,300. And that's how Nolan would account for actually doing some of the repairs. It would be reducing its liability and then crediting cash and its parts inventory. This now concludes the cornerstone and problem sets to be reviewed in Chapter 8. I would encourage you, however, to focus on the other assigned pages in the chapter that go over some of the characteristics of liabilities and remind you of some of the basics of liabilities in case you'd forgotten them from earlier chapters.